$2,000. That's all it takes now. Starting May 2025, FINRA Rule 4210 just changed the game for every aspiring day trader in America. But here's what they're not telling you about this new rule, and why 90% of traders will still fail even with lower minimums.
FINRA Rule 4210 governs margin requirements, basically, how much money you need in your account to trade with borrowed funds. Before May 2025, you needed $25,000 just to open a margin account. That barrier kept most retail traders out entirely. But now, FINRA dropped it to just $2,000. That's a 92% reduction. This opens day trading to millions of new traders, but it also means more competition, more volatility, and more people who don't know what they're doing.
Here's the catch. The $2,000 minimum gets you in the door. But you're still subject to the pattern day trader rule, the PDT rule. If your account is under $25,000, you can only make 3 day trades within any 5 business day period. A day trade is when you buy and sell the same security within the same day. So you can trade Monday, Tuesday, Wednesday. Then on Thursday, you're locked out until the following week. This rule was designed to protect retail traders from blowing up their accounts, but most traders just don't understand it.
So what can you trade with just $2,000? Pretty much everything a normal trader needs. Stocks like Apple, Tesla, Nvidia. ETFs like QQQ and SPY, which track the Nasdaq and S&P 500. Most brokers will also let you trade options, though some require additional approval. And crypto? Almost universally available. The $2,000 minimum is for margin accounts if you're trading cash only. Some brokers don't even have a minimum. But here's what you can't trade.
Futures contracts like oil, gold, or index futures typically require $5,000 to $10,000 minimums per contract. Forex or currency trading is available but extremely risky for beginners. Penny stocks? Technically you can trade them, but you shouldn't. They're manipulated, illiquid, and designed to separate you from your money. Also avoid holding leveraged ETFs overnight. They decay over time due to their structure. Stick to liquid, large-cap stocks and major ETFs when you're starting out.
Let's talk reality. 90% of day traders lose money. 10% trade without any plan at all. Less than 5% are consistently profitable over time. The $2,000 minimum doesn't change these statistics. What separates the 5% from the 90%?